Look, let me guess how this usually goes. You're scrolling through finance content, you see people talking about six-figure portfolios, seven-figure net worths, charts going straight up, and meanwhile, you're sitting there thinking, man, I just want to get started properly. I don't even have enough invested for this stuff to matter yet. Once I have real money, then I'll take investing seriously. You might be in the US, you might be in India, you might be anywhere in a developing economy where investing still feels intimidating. But the thought is the same. And in your head, you've made this deal with yourself. I'll focus once I have a lot more money. Here's the thing. That exact mindset is why most people never build real wealth. And today, I'm going to explain why your first $10,000 invested matters more than the next $100,000. My name is Aaron, and I spend way too much time thinking about how people actually build wealth through investing. If you're someone who feels like investing is intimidating, confusing, or something you'll figure out later when you have more money, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now let's talk about why almost everything people believe about investing milestones is backwards. The common belief and why it's wrong. Most people think investing works like this. The more money you invest, the more important it becomes. So they assume the early dollars don't really matter. Small portfolios are basically meaningless. Real investing starts at big numbers. That belief exists everywhere. In the US, people feel behind. In India and other developing nations, people think investing is only for the rich. Different reasons, same mistake. Here's what most people don't realize. Your money's importance is not proportional to its size. It's proportional to what it teaches you. And nothing teaches you more than your first $10,000 invested. The reality most people are living. Stats. Let's ground this in reality. According to Federal Reserve data, nearly 50% of Americans own no stocks at all. Of those who do invest, the median account balance is under $40,000. A large portion of people sell within the first 2 to 3 years due to fear, not logic. In India, the picture is even more extreme. Less than 10% of the population actively invests in equities. Most money still sits in fixed deposits, gold, or idle savings. Fear, not lack of opportunity, keeps people out of markets. So when someone invests their first meaningful amount, $10,000 in the US or its equivalent elsewhere, they've already done something most people never do. They started. Why $10,000 is a psychological line. Notice I didn't say $1,000 and I didn't say $100,000. $10,000 sits in a very specific psychological zone. Here's why. Below $10,000, every market move feels dramatic. Losses feel personal. Gains feel unreal. Fear is loud. Above $10,000, you're forced to pay attention. Volatility becomes real. Emotions show up. Whether that number is $10,000, 8 to 10 lakh rupees, or the local equivalent, the psychological effect is the same. Your brain finally treats investing as real life, not theory. And this is where it gets really interesting. Your first real market experience. Your first $10,000 invested guarantees one thing. You will experience discomfort. The market will go down. Your account will be red. You'll question yourself. This happens in the S&P 500. It happens in the Nifty and Sensex. It happens everywhere. And this is exactly why it matters. Because investing success isn't about intelligence. It's about emotional control under uncertainty. Your first $10,000 is where that skill is built. The next $100,000 is easier. Now you might be thinking, wait, how could $100,000 be easier than $10,000? Good question. The math is harder. The psychology is easier. By the time someone has built $10,000 invested properly, they've already learned how markets fluctuate, how emotions lie, how long-term thinking beats reaction, how boring consistency actually works. The next $100,000 is mostly repetition, same behaviors, bigger scale. The first $10,000 is where people quit.
The next $100,000 is where they compound. An analogy that makes this click. Think of investing like flying a plane. The hardest part isn't cruising at 30,000 feet, it's takeoff. Takeoff is noisy, uncomfortable, unstable. Once you're in the air, it's mostly adjustments. $10,000 is takeoff. $100,000 is cruising altitude. The identity shift. This is the core. Here's what most people completely underestimate. Your first $10,000 invested changes your identity. Before, I'm someone who might invest someday. I'm still learning. I don't want to mess this up. After, I'm an investor. I've survived volatility. I know how this feels. That shift matters even more in countries where investing isn't normalized. Once you see yourself as an investor, you stop panicking over headlines. You stop chasing tips. You start thinking in decades. That's how wealth is built. The math people misunderstand. Let's talk numbers. If you invest $10,000 and earn an average 8% annually, in 10 years, $21,600. In 20 years, $46,600. In 30 years, $100,600. The same math applies globally. The currency changes, the principle doesn't. The habit that builds the first $10,000 is what builds the next $100,000. Why most people never get past $10,000. This is where frustration kicks in for me. Most people don't fail at investing because they choose bad assets. They fail because they wait too long. They overthink. They want certainty in an uncertain system. They sit in cash waiting for the right time. And while they wait, inflation quietly does damage. Waiting feels safe, but it's not. Addressing the big objection. Now, some of you are thinking, Aaron, $10,000 is a lot of money, especially where I live. That's fair. But here's what matters. The lesson doesn't activate at $10,000 exactly. It activates as you move towards it intentionally. $1,000 teaches exposure. $5,000 teaches patience. $10,000 teaches discipline. The number is a milestone, not a requirement to begin. Actionable steps, very practical. Here's how to approach your first $10,000 invested correctly. Step 1. Start before you feel ready. Readiness is a myth. Step 2. Automate contributions. SIP, auto-invest, payroll deductions, whatever works locally. Step 3. Expect discomfort. Volatility is the price of returns. Step 4. Keep it simple. Simple portfolios outperform complex ones for beginners. Why this milestone determines your future. Once $10,000 invested feels normal to you, $50,000 feels possible, $100,000 feels logical, long-term thinking becomes natural. This is true in the US, it's true in India, it's true everywhere. Closing story. I've seen this pattern repeat across markets and countries. People who push through the first $10,000 don't just earn more, they panic less. They stay invested. And staying invested is the real advantage. Final message and call to action. Most people wait for confidence before investing, but confidence comes from investing. Your first $10,000 doesn't make you rich, it makes you capable. And capability, anywhere in the world, is what builds wealth. If this helped you think differently about investing, subscribe to the channel. This is what we do here. Clear thinking, long-term strategy, no hype. I'm Aaron, and this is how investing actually begins.